A newcomer who reports all of their pre-arrival foreign income as Canadian taxable income can overpay by $3,000 to $15,000 in their first year, according to modeling cited by Newcomer tax advisors in 2026. That is not a penalty or a fine. It is tax you simply did not owe, handed over because of one misunderstanding about how Canada treats world income. I read the fine print so you don't have to. Stick with me and I will show you exactly how to file this correctly and claim the free money most newcomers leave on the table. Here's the flip side of getting it wrong. Newcomers who skip filing because their employer already deducted tax typically miss $300 to $600 or more per year in the federal GST/HST credit, according to Maple Insight and Benefit Check. That credit is tied directly to filing a T1 return, so no return means no check, even if your income is low and you owe nothing. Advisory firms working with newcomers call tax residency confusion the number one mistake, and Skyfort and Grant Thornton note it can cost an extra $3,000 to $15,000 in unnecessary Canadian tax in your first year. Imagine you arrived on July 1st earning $80,000 abroad from January to June and $40,000 in Canada from July to December. Report the full $120,000 as Canadian income instead of just the $40,000, and that extra $80,000 can push you into higher federal and provincial brackets. That single error generates thousands in tax you never actually owed. Your whole return is built on one number, the exact date you became a resident of Canada for tax purposes. Dig out your passport stamp, your ETA or visa, your boarding passes or your first rental contract and write that date down. CRA's Completing Your Return for Newcomers Guide tells immigrants to record this entry date first, because it is the line that separates income Canada can tax from income it cannot. Now split your income into two piles: everything earned before your entry date and everything after it. Per CRA Newcomer guidance, once you become a resident, you report your world income earned after your date of entry, but you generally do not report income from before you arrived, so the foreign salary you earned back home in the months before landing does not go on your Canadian return. Only your post-arrival world income does, with foreign tax credits for any tax you already paid abroad on that post-arrival portion. This is the step most newcomers skip, and it is the one that unlocks the money. File a complete T1 return using CRA-certified NetFile software, even if your income was low or tax was already withheld from your paycheck. Gather your T4s, foreign income statements, rent receipts, tuition, and proof of entry date, submit the return, then log into CRA My Account to confirm it processed and that your benefits are set up. The filing deadline is April 30 following the tax year, and filing late delays your credits. Take Oksana, a software QA engineer who moved to Toronto and assumed she did not need to file because tax was already taken from her paycheck. Once she filed her T1 correctly, she began receiving quarterly GST/HST payments totaling roughly $400 in her first year, according to Benefit Check estimates. That is money she would have left on the table simply by not filing. The return is the trigger, not the tax owing. If you rent in Ontario, this step is worth real cash. Complete Form On Ben with your actual rent or property tax paid. Oksana's was $18,000 for the year. And you can qualify for the Ontario Trillium benefit, which Benefit Check says can run from several hundred to over $1,000 per year for low to moderate income renters. Ontario Newcomer guidance warns that many people either skip On Ben entirely or enter approximate rent and lose part of the benefit. Use your receipts and lease so the numbers are exact. Before I get to the last step, which is the most counterintuitive piece of this, look at what Oksana gained. Between roughly $400 a year in GST/HST credit and $700 to $900 a year in Ontario Trillium and related credits, she unlocked about $100 to $300 per year with zero additional tax owing, according to Maple Insight and Benefit Check figures. If this is useful, subscribe. The next breakdown is already coming. Here is the part that surprises people. The residency mistake runs in both directions. While you leave off pre-arrival income, you must include foreign income earned after you became a resident, per CRA and Grant Thornton guidance, or you risk a reassessment later. The good news is foreign tax credits stop you from being taxed twice on the same money. And if you hold specified foreign property worth more than $100,000, note that Form T135 may apply. So confirm the current threshold with CRA when you file. Let me kill the most damaging myth head on. Many newcomers believe that because their employer already withheld tax, or because their income was low, they do not need to file. But CRA and Newcomer guides make filing a T1 the gateway to the GST/HST credit, the Canada Workers Benefit, the Canada Child Benefit, and provincial credits. Skipping it can cost $300 to $600 or more a year in GST, HST alone, even when your final tax owing is zero. Stack it all up over time, and the numbers get serious. For someone like Oksana, avoiding the pre-arrival misreporting saves an estimated $5,000 in year one, the midpoint of that $3,000 to $15,000 advisor range, while the unlocked benefits add roughly $1,200 a year. Filed properly for 20 years, that is about $24,000 in credits plus the $5,000 tax saving, for a combined impact near $29,000 before any investment growth, based on modeling cited by Newcomer advisors. Here is your 5-step check, fast. Pin down your exact residency date, split pre-arrival from post-arrival income and file a full T1 even if your income is low. Then complete on-ben or your provincial form with your exact rent, and report your post-arrival foreign income using foreign tax credits, so you are never taxed twice. Do those 5 things and you avoid both the overpayment and the missed benefits. Your first Canadian tax return is not just about tax owing, it is the trigger for thousands of dollars in credits and the difference between overpaying and getting it right. Next, I'm covering how newcomers should open and use a TFSA and RRSP in their first year without triggering costly contribution room mistakes. If you want to catch that, subscribe so you don't miss it.